Hi, this is Michael Fisher for savingandinvesting.com, and in this first video I'd like to speak about 401k plans in the United States. A 401k plan is a tax-qualified deferred compensation plan, meaning, and in this video when we talk about 401k plans, we're going to talk about traditional 401k plans. We're going to discuss Roth 401k plans in a separate video. Now, 401k plans allow saving for retirement, and in particular, they allow contributions to be made from an income or a salary on a tax-efficient basis, and that the money that is contributed is not subject to income tax. The returns in the plan are not subject to income tax, and when the money is taken out, tax is paid, but typically at a much lower tax rate. Because the individual then would be in retirement and would be earning much less money. And furthermore, the money would have compounded ideally for all those years on a tax efficient basis, i.e. with no tax on the returns, no income tax, no capital gains tax in any given year that the money was in the plan. There are certain penalties for withdrawing the money early, and there are years, and the money does have to be kept in the plan ideally for some time. And also, the money must then be taken out at a certain age, which is currently 70 and a half years. But nonetheless, during the time of employment, during our younger years, we can effectively contribute money to a 401k plan without paying any tax on that money. The 401k plan is employer sponsored in that the employer sets it up and designs it, and the employee then chooses from a set of investments which typically include mutual funds that can invest in various stock markets or groups of stocks or global stock markets or the stock markets of particular sectors or regions, depending on what is made available within the plan. The 401k plan is also considered a salary reduction plan in the sense that the amount of money that's contributed doesn't even appear on the 1040 tax return in the year that it's contributed, and effectively simulates a lower income. So if we choose to put $10,000 into a 401k plan this year, we effectively put that money in on a tax-free basis. So if we're paying roughly 35% tax, instead of having $6,500 in our pockets, we end up with $10,000 in our 401k plan. Furthermore, all the future returns of that in that plan are gathered with no tax on the returns that we make. There are limits as to how much can be contributed in any given year into such a plan, because it is very tax efficient, and the idea is to contribute over many years a reasonable sum and to effectively then end up with a very large sum upon retirement ideally. There are also penalties for early withdrawal. And there are also, the money it has to be taken out at some point in time, and it has to start in the year after the individual currently today turns 70 and a half. But these specific items could change over time. The amount that can be contributed has been increasing over the years, increases on a yearly basis over the years. Potentially the year in which the penalties apply or the years during which the money has to be taken out could change over time as well. But what's very important is that the 401k plan is a real-world application of many of the concepts that we've discussed in the videos to date, including the fact that as a 401k plan participant, we effectively are a saver and an investor. We become a provider of capital to companies and governments, potentially via mutual funds. We can make use of dollar cost averaging if we contribute over many years, periodically. It also makes use of taxes and compounding and the implication of paying lower taxes on amounts contributed and on returns. It also takes into account the impact of time, and that the returns of a stock market historically have been much more predictable if we take into account, for example, longer time period. So a 401k plan is a type of retirement savings instrument that's made available to employees in the United States. It's set up and designed by the employer and typically offers access to numerous mutual funds and potentially even the purchases in the company's stock. It allows taxes to be saved on the amounts contributed and on the returns, subject to certain conditions which have to be very clearly understood and read prior to participating. But the reality is that ultimately many of us will retire and rely on our retirement savings for our income and for our financial well-being. And often we think of our next year and our next few years, especially in our younger years, but a 401k plan is an effective way of setting aside money for future years, effectively simulating a lower income by paying less tax and by also not having access to that money effectively, and then creating a tax-efficient lump sum that can be withdrawn on a more tax-efficient basis in retirement when tax rates are typically lower, and while not having paid taxes on the returns in any given year. Of course, given the ups and downs of the stock market on an annual basis, assets in the stock market, assets in a 401k plan can also decline as well as go up. But as we've seen historically, the stock market the U.S. stock market, the S&P 500, has offered very reasonable returns over longer time periods. A 401k plan is a type of defined contribution plan in that we as employees define the contribution and in fact also play a role in choosing the investments. But that is in contrast to a defined benefit plan where the benefit is defined and the risk lies much more with the company who is providing the defined benefit than it does lie with the amount that we contribute and the returns that we get. And furthermore, the contributions made to a 401k plan are generally shielded from the creditors of the employer, i.e. if the company has financial difficulty, the 401k assets, because it's a defined contribution, are separate from that. And furthermore, because the government wants to incentivize saving and investing and wants to ensure that sums are set aside and that they continue to exist on a set-aside basis, the amounts contributed to a 401k plan are also typically shielded from the creditors of the individual that contributed the sums to the plan. So the 401k plan is a very real-world example of a very tax-efficient potential savings tool for retirement that is offered by many employers in the United States that allows contributions to be made on an untaxed basis, returns to be gained on an untaxed basis, with taxes then being paid upon a withdrawal from the 401k plan, subject to certain conditions, years, ages, and penalties, but nonetheless can potentially allow a much larger sum to be contributed into the plan than that sum would have been if we had taken it as income in the given year in question. The 401k structure is in effect an envelope within which we can hold mutual funds and other investments, and it's not the 401k per se is not an investment. It is really a way of holding investments and of creating investments and of saving and investing. And in that context, all of the other concepts and considerations that we've spoken about and that are important within the context of saving and investing, such as dollar cost averaging, diversification, the impact of time, and so forth, are still very much paramount considerations. But the 401k structure in and of itself is a very interesting tax-incentivized way of deferring compensation into the future and saving on a tax-free basis for retirement years. And it is a very good example of a structure that's been put in place to incentivize saving for future years, given that it is in the government's interest to have retirees with sufficient capital set aside to be able to live comfortable lives and to be able to support themselves adequately during their later years.